Welcome to the update for the week of January 9th, 2023, and welcome to a new year. I'm Will Woodall from STRAT and joined, as always, by Mike Rarey from STRAT. Mike, Happy New Year.
Happy New Year, Will.
How were the holidays for you? Did you enjoy yourself?
Excellent. Plenty of family time. Maybe more than I even wanted. So it was great.
That's great. Well, we've got a lot to talk about. We're going to give a December update and look at what happened to markets in December and then talk about the outlook for 2023. A lot has already happened in the start of 23, so we'll want to sort of discuss a little bit of that and then wrap that in our framework and take a brief look at what we think 2023 will sort of evolve into as we move from sort of the inflation narrative to the recession potential narrative. Start with the December numbers and equities, and we throw those up on the board.
Yep.
Take us through the numbers.
Tough month for U.S. equities. Month of December, the S&P 500 was hanging around 4,000 in terms of price level until we got to the December Fed meeting. And at that meeting, the Fed delivered a 50 basis point rate hike, so slowing the pace of rate hikes. That was expected. On taken at face value, you would think slowing the pace of rate hikes would be good for equities, but it was the press conference afterwards and the summary of economic projections that really led to the downward momentum in the equity market. Specifically, Jerome Powell reinforcing the idea that even if we slow the pace of rate hikes, they're likely to remain elevated for longer than during previous cycles. And then also the Fed, when they published their economic projections, really not looking great. Particularly the unemployment picture, forecasting an increase in the unemployment rate that, based on history, only happens during a recession.
Yeah. And let's move over to the fixed income returns on the next chart. Take a look at those. We also saw some weakness there.
Yep. Yeah, we saw U.S. Treasury yields rise across the curve. At the very shorter end of the yield curve, the starting yields are so attractive that, for example, the 2-year Treasury note and short-term bonds were able to eke out positive total returns, even though price returns were negative because of those strong coupon payments. But as we get further out on the yield curve, the surprise during the month was the Bank of Japan, really the last major central bank to not make any hawkish moves yet. And they came out and surprised markets by adjusting the cap that they enforce on the 10-year Japanese government bond, revising that upwards. And so, its bond market is global. When that happened, yields on Japanese government bonds rose, and it kicked off similar increases in yields in other government bonds at around the 10-year point and longer. So slightly negative returns at the long end.
And then finally, let's look at alts. Also a tough month for alternative investments.
Yeah, tough month. Commodities down. You see, really the only portion of the commodity complex with a negative return was energy, and then particularly within energy, natural gas prices. And that's bad news if you're invested in a basket of commodities, but that's great news. For example, if you're in Europe, a much milder winter than previously feared has allowed natural gas prices to come down significantly and stockpiles to build. So that is good news. It also means good news for inflation over the next few months.
Yeah, and let's turn our attention to inflation on the next chart and just update the viewers on our inflation forecast. I think that's been the driver of a lot of volatility in the market throughout last year and perhaps just recently. But as we've seen this inflation narrative play itself out and start to decline, the path of the decline in inflation is super important to how the Fed will react into policy. So take us through our forecast and maybe where we see inflation versus the consensus.
Mm-hmm. Looking out into our forecast horizon, you see these lines. Those are all during 2023. They're coming down a little quicker than we had shown previously. And that's really because the last 2 CPI reports, the October and the November, both came in cooler than expected. So the fact that inflation is coming in cooler than expected is good for future inflation. If you think of, for example, moving averages as being leading predictors of future inflation prints, that's great. Also, the inflation surprise is an input to our model. So the fact that not only is it coming down, but it's coming down faster than the consensus, that also helps. And those two elements are just unequivocally good. There are no negative consequences of that. But the other reasons why our inflation forecasts are coming down, there are more good news, bad news. Housing prices coming down more than anyone previously expected. Seeing recession probability rising, money supply growth or lack of growth, money supply shrinking even at historically low levels. And those things tend to have negative economic consequences associated with them.
Mm-hmm.
So, definitely excited inflation is coming down, but sort of be careful what you wish for. How it comes down is important.
Right. And I think maybe sort of leaning into the next chart on how the Fed sees it, the ability for the Fed to raise interest rates as inflation is coming down, obviously it gets easier the faster inflation comes down. However, what sort of has historically the Fed done in this instance where inflation is falling rapidly, but they're still in a hiking cycle?
Right, right. Normally, when you see inflation coming down as we expect it, the Fed is done hiking. They're thinking about cutting. Usually, you only get this significant of a decrease in inflation during a very difficult economic time period like a recession. So, if you think about how this has historically played out, you look at the blue line, which is the Fed funds rate plus this goes all the way back to 1960. So all the way to the right, you see a little lighter blue. That's our forecast for the Fed funds rate, peaking at right around 5% mid 2023. And then the green line is core CPI. And the Fed has never stopped a hiking cycle when inflation is running above the Fed funds rate. So this is key. If we think inflation's coming down and the Fed's still going to be hiking, why are they doing that? Well, because they have to get the blue line above the green line. Mm-hmm. And it looks like they're going to cross paths right around mid 2023. And so this is one of the big reasons why markets have been excited more recently here, thinking, hey, if the Fed gets the Fed funds rate up to 5 and inflation comes down as we think, then the Fed can stop hiking. And so that's a big reason why the market has sort of coalesced around this idea that the peak Fed funds rate for this cycle is going to be 5%.
Yeah, and that's a reasonable sort of narrative to attach to this. But as you see in this graph, the Fed can continue to hike rates well beyond that green line, in some cases, significantly above. Also, I think the narrative of then they'll cut is, we don't see any evidence for that. Stopping at 5 and staying at 5 seems like the most reasonable outcome in the near term, which, and absent any other evidence, seems like that's the path they're headed on. I think as they've gone through this process, they need to slow down inflation and make sure it's defeated before they even think about cutting rates again. Yep. So it'll be interesting to see how it plays out. You made a comment about liquidity, and so let's move to the next chart. Our liquidity forecast, we're seeing it bottom out here and starting to move higher, and we'll talk about that in the money supply and how those two interact with each other, but take us through sort of the uptick in our liquidity forecast.
Actual money supply data now is published through the end of November. And so that's the dark blue line. And you see we set a new record in November. Now we're at 0% year over year change in the money supply. Where in March 2021, we set a different record where we were at over 25% year over year change in the money supply. So this, no doubt, has been, in terms of level and rate of change, we are in the worst liquidity environment in history. So another one for the record books. I know we've seen in the comments before, it seems like all we say is unprecedented. Well, that's what happens when that's the word you use when this stuff happens, right?
Yeah.
So
chart, right.
Exactly. And so when you think about our regimes going forward, well, it was previously understood that 0% was the lower bound for liquidity, because in theory, you should never destroy money. Why would we ever destroy money, right? And so money supply growth had never dipped below 0. But we hit 0 in November. And if you follow our framework, that would mean, well, by default, we're going to be low and rising over the next 12 months. And that is typically a good thing for equities. You'd say low and rising. All right, rate hike cycle's over. Let's buy some equities. But we have to put some sort of guardrails around that, because low and rising, the reason why that's historically been good for equities is because it typically happens when we're coming out of a recession, the Fed funds rate has been cut dramatically, and or the Fed's balance sheet is increasing. So you have a complete shift in monetary policy towards being more dovish, and the economy is starting to rebound. And that's typically low and rising. And you understand, if you paint that picture, why that would also be a good environment for equities. But this low is different than any other low we've seen before. And it's not coming with a decrease in the Fed funds rate or an increase in the Fed's and the size of the Fed's balance sheet. And we're not forecasting a substantial improvement in economic growth next year.
Right.
So we're not excited about this.
So let's piggyback off that and look at the money supply, because here's another unprecedented chart. I mean, we've never seen the money supply fall to these levels.
Yeah. And this is the same metric. This is M2, the money supply. This is the 9-month percent change. And why did we choose 9 months? Well, because the Fed started hiking rates in March. So it was approximately 9 months ago. And over the last 9 months, you see we've gone negative. There are 400 billion fewer US dollars worth of money supply today than there were in March. And once again, that's something we've never seen before, but it's literally less money, more problems. I mean, if you're trying to think, how can we continue to grow the economy and still have money left over to support asset prices, but there are just fewer dollars, it doesn't add up, right? The equation breaks. It's just very difficult. So, you talked about pivot hopers, and hopers are going to hope, right? But it's very difficult to think about us going through this type of a slowdown in money supply, actually having less money than we did 9 months ago, and also think everything's going to be rosy or soft landing on the economic front over the next 12 months.
Right. Yeah, and that really leads into our GDP outlook and what we're forecasting for the next several quarters. Take us through the consensus numbers and what our thoughts are around those.
Yeah. Yeah, and the first thing, the dark blue line, is the 2022 real GDP consensus. That's come up. That's good news. It's about 40 basis points now for this full calendar year. And part of that is because consumption in Q4 PCE has been pretty good. But you see the light blue line is expectation for 2023, and that's just come down by the same amount. And so basically what's happened here is, if there's less money than there was and inflation is still high, then what that essentially means is, if consumption is good now, consumers are spending their savings, or they're adding to credit card debt, et cetera. They're leveraging up their balance sheets. And if you're spending savings or you're adding debt in order to consume today, that means you probably will have less money to consume tomorrow. And so it makes sense to see, we might see a 4% GDP growth number for Q4 when it finally comes out, Q4 2022. Mm-hmm. And that probably means there's just going to be slower consumption in 2023.
Right. It just makes Q1 of 23 and Q2 of 23 potentially weaker. Right. Yeah. So given that, in terms of the potential for recession, our recession indicator has been going off here for a while. Take us through the update and where we stand today on recessions.
Yeah, the numbers look very similar to the last time we provided an update, and the underlying drivers are very similar as well. So every one of the underlying economic indicators we track that are related to anything outside of the labor market is basically saying there's a very elevated probability of recession. Basically, the unprecedented strength in the labor market and the continued resilience of the labor market is the reason why the probability of us being in a recession right now is relatively low. It's only 25%. And then the fact that the Fed continues to think the tight labor market is a problem is the reason why the other economic data points and the market-based data points are signaling, hey, there's a high probability of a recession in the next 6 to 12 months. So the labor market will definitely be a focal point during 2023. We've been focusing on it. Everybody's been focusing on inflation prints for so long now. There will be a handoff, we believe, in 2023 where the inflation readings, when they come out, they don't get as much press as the non-farm payrolls report.
Yeah. So let's sort of piggyback. We've had some questions on sort of our employment outlook, and we're starting to see companies announce layoffs, but we still see an unprecedented number of job openings. Sort of square the edges for that for us.
Yeah. So in theory, well, we know when it comes to the announced job cuts, they are significant. They're very large, and a lot of them are driven by margin pressure and poor operating performance, and overhiring during the pandemic. And typically what happens is before you announce job cuts, you remove job openings. And so you usually see job cuts rise and job openings fall at the same time. This time has been different. The JOLTS number has been stubbornly high. And this has reinforced here very recently this idea of maybe a soft landing is possible. Because in theory, anybody who loses their job can just turn around and get another one. And then that would result in no increase in the unemployment rate. And if we don't have an increase in the unemployment rate, how could we possibly have a recession? And that's 100% correct. But you have to think about the Fed's reaction function, right? The Fed views a low unemployment rate and the high job openings rate both as problems that they are going to solve. So the longer and longer it seems like job openings aren't coming down, the unemployment rate isn't coming up, potentially that just means the Fed is going to hike even more.
Yeah.
So they can make sure that they've defeated inflation. So the end point is the Fed has made the end point almost certain. It's just sort of how quickly do we get there?
Yeah. As we sort of wrap up here, looking into 23, we're still seeing growth potential very low, inflation falling, high and falling, becoming more reasonable. No immediate change in policy. What other things in 23 are we looking at that are important for investors to be evaluating?
Well, the last piece around this entire macro framework that we've outlined are just prices. Prices, and then we can also talk about earnings. But prices are very important. How much of this is already priced in? I mean, you could have an environment where everything we just laid out in terms of economic growth, liquidity, recession probability plays out, but it's already been priced in, and so equities have a positive return. So we take all of this and we run it through our prices framework. And what we see, there are some areas of the equity market that a lot of this is already priced in, and they have a reasonable expected return. This is not priced into the bond market, meaning bonds are very cheap relative to this outlook. This is not priced into growth stocks, meaning growth stocks are very expensive relative to this macro outlook. So that's definitely something you can't, even if you had this macro framework, you have to analyze prices in order to make good investment decisions. So that's always going to be a thing.
Yeah, maybe I think an important thing to comment on, we've been talking about 23 as being the year for bonds. Give us an update on that.
When bonds are going to start to have their day is when the market fully transitions its focus away from worrying about inflation, worrying about the Fed continuing to have to hike rates, which we're in the process right now of going through that. That's why fixed income during Q4 performed relatively well. And they fully transition their focus to slowing economic growth and the potential for a recession. And, based on our framework and how that's sort of panning out, it looks like Q1 and Q2 in particular of 2023, that's going to be the market's primary focus. Fed's done hiking, inflation's coming down. All right, what's going to be the collateral damage to the economy? And then that typically results in bond yields falling, bond prices rising, and you're getting paid a good amount to wait for that to happen, right? Because current yields are attractive.
Yeah. it's going to be a really interesting earnings season to see how companies are acclimating to this changing environment, and potentially when recession comes, if it comes, which it looks like it's going to, how deep will it be? And that potentially that would change the outlook for bonds even more favorably, perhaps. So a lot more to come there. We're super excited for 23. We think our framework has done a great job at sort of helping us forecast the asset classes we should be in. If you want to talk through any of these items with us, feel free to reach out to us. As always, we're looking forward to a great year, and thanks for joining.